Most retail traders spend their time trying to guess whether a stock's price will go up or down. Institutional traders take a different approach. They largely ignore price direction and instead trade the underlying volatility waveform. Look at this chart of the VIX index. During extreme market events, like the massive peak you see here in late 2008, volatility behaves erratically, spiking to reflect widespread market panic. Underneath that apparent chaos are measurable statistical tendencies. By adapting institutional research and machine learning models, we can extract a 4-step volatility arbitrage system. This system replaces the guesswork of price prediction with a data-driven checklist. You learn to identify when risk is mispriced in the options market and extract the mathematical difference. Step 1 is setting up your charts to measure the true cost of an option. To do this, you need to overlay historical volatility, which tracks what the stock has actually done, alongside implied volatility, which measures what the options market expects it to do. A common mistake is looking at the overall S&P 500 VIX index to trade an individual stock. You need to use the stock-specific implied volatility, often called IVX, which isolates the expected risk for that specific equity. Here is a counterintuitive truth about option pricing. Implied volatility is not an input you plug into a model to get an option's price. It is an output generated by the market price of the option itself. And because market participants constantly overpay for insurance, implied volatility structurally overstates actual historical volatility. That persistent overpayment creates the measurable gap you see here. When the implied volatility line expands significantly above the historical volatility line, the options are expensive. This gap is known as the Volatility Risk Premium. This specific, measurable distance between expected fear and historical reality is exactly where the options trader finds their edge. Step 2 defines our execution rules. When implied volatility is historically high, we look for credit spreads, which means we sell premium. When implied volatility is historically low, we look for debit spreads, buying premium. This binary rule relies on a statistical reality. Unlike stock prices, which can theoretically climb indefinitely, implied volatility is strongly mean reverting. It cannot trend indefinitely in one direction. This scatter plot visualizes that inverse relationship. When current implied volatility on the x-axis is high, the forward average volatility on the y-axis tends to be lower. High volatility often signals its own decline, creating a structural setup to sell high and buy back lower. By trading this mean reversion, you isolate the volatility factor. If you sell when volatility is high and it subsequently reverts to the mean, you can profit regardless of which way the underlying stock price moves. Step 3 brings intraday timing into the equation. Volatility is not static throughout the trading session, meaning the exact hour you execute your trade changes your mathematical probability of success. This chart, based on institutional research from the Australian options markets, maps standardized average order depth across a single trading day. It reveals distinct U-shape and M-shape intraday patterns. Notice the elevated peaks at the market open and the market close. These periods represent intense hedging activity and information processing, which often coincide with the day's highest volatility. For a seller, these peaks represent the moments when premiums are most bloated, giving you the largest margin for error. Data also shows these closing periods, specifically on Mondays and Tuesdays, hold the highest predictive power for option pricing for the rest of the week. Now look at the midday dip. During this lunchtime lull, trading volume drops and implied volatility temporarily deflates. This trough creates the ideal condition for buying premium, as you aren't paying the panic tax associated with the opening or closing bell. Executing sell orders blindly at midday when the market is quiet, or buying premium during the chaotic opening bell, actively works against your statistical advantage. Aligning your trade direction with the correct intraday volume peak or trough optimizes your entry price. Step 4 is risk management. To survive unexpected market shocks, you must scale your position sizing inversely to the current implied volatility level. These side-by-side charts map implied volatility across different strike prices, known as volatility skew. Checking this skew is a mandatory prerequisite before entering any trade. A sharply shifting skew curve, specifically with elevated pricing on the put side, acts as an early warning system. It tells you that downside puts are already pricing in massive market fear. Institutional quants recognize that standard models often fail during high volatility regimes, requiring advanced differential machine learning to account for sudden extreme price jumps. Retail traders lack these high-frequency tools, so they must compensate with a defensive allocation strategy. When implied volatility hits the 90th percentile, the institutional response is complex math. The retail response should be simple. Cut your capital allocation in half to account for the risk of unmodeled price jumps. Having a perfect statistical edge means nothing if poor sizing during a sudden volatility spike wipes out your trading account. You now have a mathematical framework for trading options. You are no longer guessing where a stock's price will go, but actively trading structural mispricings using historical data. Find the gap between implied and historical volatility. Trade the mean reversion setup. Execute your order at the optimal intraday hour and scale your risk based on the skew. It is time to open your trading charts, isolate today's specific volatility mismatch in the market, and flawlessly execute the complete arbitrage checklist.